Hi, hello everyone. Welcome back to my channel. In this video, we'll be discussing on the applicability of accounting standards to the cooperative societies. Kindly watch the video till the end, like it, share and subscribe. If you have any comments about the video, please put your comments in the comment box. Now, let us move to the presentation. Of course, the cooperative societies are also not an exception to the applicability of the accounting standards. The financial statements prepared by the cooperative societies are general purpose financial statements. This general purpose financial statements include balance sheet, statement of profit or loss, cash flow statement applicable to a few cooperative societies, and statements and explanatory notes which form part thereof issued for the use of various stakeholders such as government and other agencies and the general public shareholders also. Thus, it is amply clear that accounting standards issued by the ICI, that is Institute of Chartered Accountants, are also applicable to cooperative societies. So these are the cooperative societies which are applicable to the cooperative. These are the accounting standards which are applicable to the various types of cooperative societies. Such standards can be Accounting Standard 1, disclosure of significant accounting policies. AS2, that is Accounting Standard 2, valuation of inventory. Accounting Standard 6, depreciation accounting. Accounting Standard 9, revenue recognition. Accounting Standard 10, accounting for fixed assets. Accounting 14, accounting for amalgamation. Accounting Standard 15, employee benefits. Accounting Standard 17, segment reporting. Accounting Standard 22, accounting for taxes on incomes. Accounting Standard 24, discounting operations. Accounting Standard 28, impairment of assets. We shall discuss the applicability of these accounting standards in detail in the subsequent slides. Firstly, the Accounting Standard 1, disclosure of significant accounting policies. This is the accounting standard issued by Institute of Chartered Accountants of India in November 1979 on the disclosure of accounting policies followed by the business enterprise. This standard deals with the disclosure of significant accounting policies which have been followed in preparing the financial statements. The standards concentrate on the fundamental assumptions like a going concern concept, consistency, and accrual concept of accounting here. Here, going concern concept here, the shareholders may come or may go, but the cooperative societies goes on forever. So, in other words, to say, the shareholders are separately treated from the cooperative society organization. In other words, to say, there is the implication of the separate legal entity concept, then consistency and accrual. Here, whenever the expenditure is due, whenever the expenditure is the incomes are receivable, all those are concerned while preparing the financial statements. Then it also considers the recognition of income and the provision for making sufficient expenses. Say, for example, whether during the course of the preparation of the financial statements, a provision for income tax may be kept, or it may be raised in the by debiting the profit and loss account. Then similarly, the other some provisions can also be created, like it may be like a reserve for doubtful debts, all these things. So this standard considers these things when in case of the preparing the financial statements here. Since the accounting policies adopted could vastly differ from society to society, and even after a year in respect of the same cooperative society, Accounting Standard 1, by forcing the disclosure of accounting policies, ensures that the users of financial statements, here the users are none other than the stakeholders, I mean to say the government and other agency, public and the shareholders, would be able to do a meaningful comparison of such statements and draw proper conclusions from them. This accounting standard policy has been made mandatory in respect of the accounts for the period which are prepared after 1/4/1991 onwards. When the disclosure practice is followed by the cooperative societies, it will help the public to make investment or by subscribing to the shares of the cooperative society, or else they can also become the customer of such cooperative society by borrowing the loan, or say for example for making the deposits in such a society here. Now let's take the second one here, that is Accounting Standard 2, valuation of inventories. This is the accounting standard which was issued by ICI in June 1981. There are varied practices of inventory valuation applicable currently, and hence the accounting standards seeks to narrow the differences. The standard applies to inventories which comprises of finished goods, work in progress and raw materials. So this standard, that is valuation of inventories, applicable to the producer and trading cooperative societies. The valuation of the inventory will be made on the basis of the cost or the net realized value, whichever is lower. The standard specifies that the cost of inventory should be normally determined by using a FIFO method, that is a first in first out method, or average cost method, or LIFO, last in first out method. It also specifies the circumstances in which the specific cost and standard cost method of valuation may be used. But this standard is not an apt to the cooperative societies, as the cooperative societies lack of detailed accounting records, and this standard is not universally applicable for all the cooperative societies. It focuses only on the producer and trading cooperative societies, where the stock of the inventories will be taken out. So the standard is more applicable only for the producer and the cooperative trading cooperative societies. Then comes here AS6, that is Accounting Standard 6, that is depreciation accounting. All of us, we know that depreciation is the continuous, permanent, gradual reduction in the book value of the fixed asset. So this standard was issued by the Institute of Chartered Accountants of India in November 1982. The AS4 the AS6 states that the amount of depreciation to be charged is determined on the basis of the certain factors such as historical cost, expected useful life of the asset, and estimated residual value of the depreciable asset. So here the historical cost is nothing but the cost which is incurred in the past. In other words, to say, it includes the purchase cost of the asset. Then the expected useful life of the asset means here the number of years for which an asset may be used in the organization. Then the estimated residual value, which means nothing but the scrap value at the end of the life of the asset when it is sold after the completion of its life. Here this standard recognizes straight line method and written down value method of depreciation. The standards provides with respect to the calculation of depreciation on fixed assets of the cooperative societies. But very surprising is that the rate of depreciations are not at all specified by the Cooperative Societies Act of 1912, unlike the Income Tax Act. AS 6 specifies that the depreciation method selected must be applied consistently from the period to period. It means that suppose the straight line method is followed for a particular year and which shall be continued subsequently also, there should not be any delinkage of for 1 year one method of depreciation, for another year another method of depreciation. It should not be followed. Suppose, say for example, if return down value method of depreciation is followed for this year, next year also the same method should be continued unless there is a reason to change. So the method of selection of depreciation depends upon the type of the asset, the nature of the use of the asset, and the circumstances that are prevailing in the business. The method of charging depreciation may be changed only if such a change is required by the statute, or for compliance with an accounting standard, or if it is considered that the change would result in a more appropriate preparation or presentation of the financial statements of the enterprise. When there is a change in the method of depreciation, then the unamortized depreciable amount of the asset should be charged to revenue account, that is the profit and loss account, over the remaining useful life of the asset by applying the new method. So there should be consistency in the method of depreciation on the fixed assets. The next one comes here, revenue recognition concept, that is AS9. So this accounting standard was issued by the ICI in November 1985, but which has made it a mandatory with effect from 1/4/1991. This standard deals with the various bases adopted in accounting the revenue in the profit and loss account of an enterprise. The types of the revenue dealt with this standard are revenue from the sale of goods, rendering of service, and the use by others of the resources of the enterprise, yielding interest, royalties, and dividends here. So in case of the cooperative societies, more applicable to the credit cooperative societies, which render service in the form of providing loans to the employees as well as the public also. It should recognize the interest on the non-performing asset. Here non-performing asset means if any loan whose repayment may not be made within 90 days from the borrowing of the loan, here such a loan will be called as a non-performing asset. So interest recognition on non-performing asset is most important. The cooperative banks are governed by the Reserve Bank of India and liable to follow the stipulations laid down by the RBI. According to this standard, the prudential norms of classification provisions or of advances should be mentioned by the cooperative societies. It is important to note that interest on overdue deposits and its method of recognition should also be mentioned here. Here, the NPAs, it should recognize the interest which is due on the NPAs here, that is non-performing assets at an early stage. Then the next one comes here, AS10, that is accounting for fixed assets. This was issued by the ICI in April 1991. According to this standard, it deals with the accounting of fixed asset. The term fixed assets connotes an asset held with the intention of being used for the purpose of producing or providing goods or services, and which is not held for the sale in the normal course of the business. The standard relates to the accounting of the fixed assets of the cooperative societies. There should be clear classification of fixed assets according to the nature of the asset. As per this standard, any expenditure incurred on the purchase or acquisition of fixed asset should be capitalized and should be shown in the balance sheet. It should also mention the disposal of the assets after their active use in the balance sheet separately. which means that, for example, a furniture is purchased and which has an expected life of 10 years. Even after 10 years, if the same furniture is continued to be used in the society, it must be clearly stated in the balance sheet with respect to the after its active life, still it is going to use. So that's why the value of such asset must be clearly and distinctively shown in the balance sheet. There should be clear classification of fixed assets according to the nature of the use of the asset in the society. Here the if there is any addition to the assets, the AS10 pertaining to the additions of the asset, which states that the existing assets according to AS10 relating to the accounting for fixed assets, only expenditure that increases the future benefits from the existing assets beyond its previously assessed standard of performance is included in the gross book value here. Even in case of the revaluation of the assets, the revaluation of fixed assets should be done as per the norms mentioned in this standard. The standard states that fixed assets may be restated in the value with the help of appraisal undertaken by competent valuers. Such change in the value of asset is called revaluation. Even that revaluation of fixed assets should also be made as per the norms mentioned in this standard. Then comes here AS 14, that is accounting for amalgamation. This standard relates to the mergers and acquisitions of cooperative society. It is more applicable to a multi-state cooperative society. The examples of the mergers in case of the cooperative society sector: Cosmos Bank and Annapurna Mahila Saharkari Bank, Manasa Urban Cooperative Bank of Ahmedabad with Unnati Cooperative Vadodara. So as a result of that, the AS 14 is also applicable, and such mergers follows two methods here, that is pooling interest method and purchase method here. In case of the pooling interest method, the assets are the record of assets, liabilities and reserves by the transferee society at the existing values which are shown by the transferor company or transfer society here. Then there is an adoption of unique accounting policies in case of existence of confliction between the transferor and the transferee here. So you should clearly mention the method of amalgamation and the terms and conditions for amalgamation of the cooperative societies. The effects of the financial statements of any changes in accounting policies as a result of the adoption must be reported in accordance with the accounting standard 5, that is a prior period and extraordinary items and changes in the accounting policies. The purchase method, the transferee society account for the amalgamation either by incorporating the assets and the liabilities at their existing carrying accounts, or by allocating the consideration of individual identifiable assets and liabilities of the transferor society on the basis of their fair values at the date of amalgamation. The identifiable assets and liabilities may include the assets and liabilities which are not recorded in the financial statements of the transfer company. In other words, to say, on the date of the purchase here, there should be revaluation of assets and liabilities, and the revalued assets and liabilities must be accounted by the transfer company as per the purchase method here. Then the next one comes here, AS 15, that is employee benefits. This standard states the employee benefits are all forms of consideration given by an enterprise in exchange for services rendered by the employees. So it may be in the form of a pay package, or it may be what we call it as a post-employment benefits and post-retirement benefits. So here the benefits are classified into two categories, that is the post-employment benefits and the retirement benefits. In case of the post-employment benefits, it is nothing but in the form of the hiking of the salary or the promotion. All these they will come, or the incentives that will come in case of the post-employment. Whereas in case of the retirement benefit, it is nothing but the gratuity and the pension which will be provided to the employees after their retirement here. So here the other benefits also includes the post-employment benefits like life insurance and the post-employment medical care. Post-employment benefit plans are formal or informal arrangements under which an enterprise provides post-employment benefits for one or more employees. Defined contribution plans are the post-employment benefit plans under which an enterprise pays a fixed contribution to a separate entity, that is called as a fund, and will have no obligation to pay further contribution if the fund does not hold sufficient assets to pay all employee benefits relating to employee service in the current and prior periods. Section 71 of the Multi-State Cooperative Society Act 1960 permits societies to establish and run employees provident fund. So now let us understand what is defined contribution plan and defined benefit plan. In case of the defined contribution plan, the enterprises, that is society's obligation is limited to the amount that it agrees to contribute to the fund. Suppose, say for example, when an employee is appointed here, so only the 12% of the salary will be contributed to the employee provident fund, so only 12% will be contributed. Then in case of the amount of the post-employment benefits received by the employee equals to the amount of contribution paid by a society and also by the employee plus investment return arising from the contribution. Suppose, say for example, if both employee and the society contributes towards a common fund called as the employees provident fund, so both their contribution plus the interest earned on such contribution will be taken into consideration. The actuarial risk, that is that benefits will be less than the expected, and investment risk, that the assets invested will be insufficient to meet expected benefits of fall on the employees here. In case of the defined benefit plan, the enterprise's obligation is to provide the agreed benefits to the current and the former employees. The actuarial risk and investment risk fall on the enterprise. If actuarial risk or investment experience are worse than the expected, enterprise's obligation may be increased here. This means every cooperative society is subject to audit. It is ensured that employees' benefits are provided for and to as explained in AS 15. Where very rarely, such as some of the multi-state cooperative banks and some other sugar factories are cognizance of the AS 15 is very well taken. If the impact is material, it is likely to violate the picture of the society, and suitable comment is required in this regard in the audit report. Then the next one comes here, AS 17, that is segment reporting. Here this segment, this AS standard is applicable to the cooperative societies which are working in a multi-state milk and milk product societies having bigger scale of operations. Such segment reports includes of three things here. That is the primary and secondary segments, trading and manufacturing. Then the cooperative banks, interest income, investment. Only two primary and secondary segments, trading and manufacturing. Then cooperative banks, interest income, investment income, and other income. So when the cooperative societies are working on a large scale, in such case, this A17 will be applied. When they have got a separate segment, say for example, if you take the milk, say if the revenue is of more than 10% from one segment of the whole revenue, then in such case this segment is applicable. Suppose, say for example, if you take the Amul as one cooperative society where there is a chocolate manufacturing, where there is a curd and all the products will be there. So if the revenue from one division, here segment is nothing but a division. So when the revenue of a particular division is more than 10% of the total revenue, In such case, this AS 17 is appropriately applicable there. Then the next one comes here, AS 22, that is accounting for taxes. This standard relates to the accounting treatment for the taxes on income of the cooperative societies. Under section 80 subclause P, certain incomes specified in case of the income of the cooperative society engaged in specific activities is considered as deduction if such income is included in the gross total income of the society. Such specific activities are mentioned in the Income Tax Act of 1961 also. And there should also be provision for a minimum alternative tax on the society. So that is what we call it as a MAT. So which is taxed at a flat rate here. Then AS 24, discounting operations. The situation of discounting operations can arise in case of a cooperative society such as a sugar factory, dairy, or a cooperative bank having operations geographically spread. Question of disposal or spin-off, that is split-offs, appears remote in case of the cooperatives. Piecemeal disposal of could be possible. Termination also is possible in case of a cooperative society. The necessary permissions and stipulations need to be looked into. Deciding initial disclosure event needs to be identified on the basis of the available documents. So when it is going to spin off, when it is going to discontinue, that is to be traced out at the earlier. The point here is the discounting operations trigger. So it should be carefully estimated with respect to the spin-off here. The pre-tax gains and the losses on disposal of the assets or the liabilities, how they are arrived at the tax and tax expense be considered carefully. Subsequent changes in the timing of cash flows needs to be reported, updated disclosures. So everything must be reported everything should be reported in the subsequent changes in the timing of the cash flows here. Then the next one comes here, AS 28, that is impairment of the asset. The very objective of the statement is to prescribe the procedures that an enterprise applies to ensure that its assets are carried not more than their recoverable amount. An asset is carried not more than its recoverable amount if its carrying amount exceeds the amount to be recovered through the use or the sale of the asset. If this is the case, the asset is described as impaired and the society is required to recognize an impairment loss. It is also essential to know when a society should reserve an impairment loss and make certain disclosure for impaired assets. So, when the carrying amount does not exceed the fair market value of the assets, it is referred as the impairment here.